start off with, I'm going to pose 3 hypothetical questions. I want you to have these in the back of your mind throughout the presentation, and we'll return back to them at the end, and maybe you'll have some questions generated by these hypotheticals. The first is, what did you have in your mind when you came into this room today about what environmental responsible investing was? What was your preconceived notion? Second idea is, with that preconceived notion, what was your assumption about the performance of environmentally responsible investing? What role would performance play in this conversation? The third question is, what role did you see environmentally responsible investing playing in your personal investments over the next 5, 10, 20 years? So those are some hypotheticals, just keep them in the back of your mind. But for now, let's dive right in. Can anyone tell me what this is a picture of?
Sandy?
Raise your hand, shout it out.
Sandy?
Sandy, that's right. This is actually a young woman in New Jersey in the aftermath of Hurricane Sandy. This is the title of Bloomberg Business Week on November 1st, 2012. Now, can I get some more guesses? What was the property damage caused by Hurricane Sandy?
100 billion.
100 billion? Any other guesses?
110.
110. See my father-in-law's playing prices right back there. It was actually 65 billion, so a little bit under that, still a huge amount of money. To put that number into context though, moving forward, the Organization for Economic Cooperation and Development has estimated that by 2070, coastal property at risk due to extreme weather and coastal flooding is $35 trillion. That is the GDP of the US, Russia, China, and India combined. I won't try and make you guess what this is a picture of. This is actually a picture of a $1.1 billion storm surge barrier being built in New Orleans. Now, outgoing Mayor Michael Bloomberg has proposed $20 billion of projects similar to this one in the aftermath of Hurricane Sandy to help mitigate the effects of future storms. There's a whole industry starting to be created in engineering and construction related to climate change adaptation. That industry is already a $1 billion industry. It's expected to grow by 40% over the next 2 years, and then to double on that number in terms of revenue by 2020. All of which is to say, if you've read the recent US climate assessment that came out of the federal government, it was talking about how the effects of climate change are already here. They're already felt in all 50 states. It's already upon us. And I use this slide as a concrete example of how the effects of climate change are already being felt in our economy and in our investments. Now, can anyone tell me who this is a picture of? Dirk is cheating. Any guesses? It's actually a trick question. This is a random picture that comes up on Wikipedia when you search for George. There's George. This conversation around environmentally responsible investing, around what's going to happen by 2070 and trillions of dollars, can become very complex and overwhelming quickly. I find I have that same feeling happen to me. What helps me, and what we're going to do today in this presentation, is we're going to compare some of the trends of environmentally responsible investing to decisions that you probably already make in your everyday life. Instead of trying to learn all of your names and make reference to all of you, though, we're going to use George. George is an environmentally responsible consumer. He drives a hybrid, he recycles, he donates to his local nonprofits, he cares about his community. Yet he hasn't taken the plunge yet into doing environmentally responsible investing. One of the things that does for George is it means he can't pass the wake-up test. When George wakes up in the morning and he gets his quarterly statement from wherever his investments are held, usually 2 things are happening. The first thing is that George has very real goals in his life. He wants to retire in 20 years. He wants to send his kids to a great college. He wants to continue to take that yearly trip abroad to Europe to visit his family over there. Looking at his returns on his investments, he tries to gauge, am I on track to continue to hit those goals? Am I going to continue to meet those goals? That's important to George, and it should be. The second thing that happens, though, is that when George looks at his quarterly statement, he can also compare the holdings that he has in that statement to his values as an individual and as a consumer. If George hates cigarettes, despises them, doesn't like what they do for the community, yet he sees a large holding in a cigarette company in his statement, that's going to cause him moral tension. He's not going to wake up in the morning and hope that overnight people bought more cigarettes, that those companies became more successful. Now, my partner and I believe that there is a middle ground you can hit where you start to express your values in a responsible way while still achieving a competitive performance. I don't expect you to take my word on that, so the rest of this presentation is going to talk about how we seek to do that. We're going to try and teach you throughout this presentation how to pass your own personal wake-up test. Oh, did I do something? I did something. I figured it out, hopefully. No. Oh, okay. Oh. Okay, we're back. We're going to do this through 5 sections. The first section, we're going to talk about the basics of environmentally responsible investing. Second section, we're going to talk about the performance conversation around environmentally responsible investing. Third section, we'll talk about the potential of this sector moving forward. Fourth section, how can you, George, how can you get involved in this conversation? And finally, in the 5th section, we'll open it up to questions and answers. So let's dive in. Can I see a show of hands who, when they walked into this room, had heard of environmentally responsible investing before? Great. That is by far the most number I've gotten in a room so far. Now, can some of you who raised your hands bravely volunteer for me and just give me what your definition was that you came into this room? Promise I'm not going to land past you. Yeah.
I'll be your cheat seat.
Yeah, thank you.
It could actually take 2 forms, one of which is find out which are the greenest companies out there, and you've mentioned some of them that are involved in making the world a better place, and investing only in those companies.
Yeah.
A second possibility goes back to something similar to the Sullivan Principles for South Africa. Companies that pledge to do better than most companies in the same industry to further the goals of whatever it is that you're trying to do, whether it's end apartheid or invest net well for the greening of the world. So
Right.
You sort of have those 2 categories.
Right. That's a really comprehensive answer. It's a great answer. I know Dane personally was in charge of some investments at Commerce Bank, so he has a hand up on some people. That's a great answer. And what it really draws attention to is that there are a lot of different ways to look at this conversation. There are a lot of different approaches you can take to how you define environmentally responsible investing. Because we're having a broader conversation here, I'm going to use a very broad definition. We're going to talk about environmental, social, and governance investing. I'm going to use ESG as shorthand. When we say environmental, social, and governance investing, the way we're going to define that is it's investing decisions that take into account the environmental, social, and governance impact of those investments alongside their financial return. Just a quick couple notes. We're mainly going to focus on the environmental side of the conversation, but this is a 3-legged stool, and these conversations often go together. And then the second note is, for those of you unfamiliar with the term governance, it means the company's management. So for example, how their board structure is set up, how their compensation structure is set up, questions like that. Now, in this conversation, there are 3 primary methods that I see environmental, social, and governance investing taking place. The first is divestment, second is shareholder advocacy, the third is impact investing. We're going to talk about each of those in a bit more detail now. We're going to use the example of George buying eggs. So, divestment. The Merriam-Webster definition of divestment is to sell. In the context of ESG investing, what that looks like is selling investments that you have a moral objection to, or avoiding investments that you have some sort of moral objection to, just not touching them. To return to our George example, let's say it's the late 60s, early 70s. The organic food movement is just starting to take root. George reads a report of EGG Egg Corporation and talks about how horrible it is. Talks about how the employees are kept in cages and fed hormone-injected foods, and the chickens get terrible compensation packages, just awful benefits. So, George decides, I'm going to sell all those eggs back. I'm not going to deal with those eggs anymore. I'm not going to buy them anymore. That would be an example of divestment. Now, can anyone give me an example of divestment that's occurred in the investment world over the last 50 years?
How many years?
50 years.
50?
Yeah.
South Africa.
South Africa. That's the prime example. The South African apartheid movement is the biggest example and the most successful example of divestment taking place. Now, there's a really interesting thing happening on college campuses right now, where students are once again pushing for divestment, except this time it is related to fossil fuels. So students on many campuses are saying, we want to divest our endowment, we want to divest from fossil fuel companies. Now, in some ways, the leader of this movement is Bill McKibben. For those of you familiar with him, he's from 350.org, and this is a quote where he's talking about divestment in fossil fuel companies. He says, it's not like there is a flaw in the business plan. The flaw is the business plan. The divestment movement on college campuses has had a mixed track record so far. A lot of colleges, a lot of board of trustees have said, it's too complex, we don't want to sacrifice performance. And they've pushed back. However, just recently, Stanford announced that they were going to divest from all coal stocks in their endowment. Fifth largest endowment in the United States, $18.7 billion. It'll be really interesting to see how this conversation evolves after a major university like that has set a precedent like that. Shareholder advocacy. Shareholder advocacy is when you use your shareholder rights to advocate for change. So if you own stock in a company, you advocate for that company to be more responsible. If we return back to our George example, let's say instead of selling all of his EGG eggs back, he decided, I'm going to write a sternly worded letter, I'm going to get my friends together, and I'm going to get this company to change as a loyal customer. Now, once again, in the investment world, we see that shareholder advocacy is starting to take place, is starting to become more prominent in relation to the environmental conversation. Now, I'm going to take a little poll again here. I want you all to shout out some numbers. How many shareholders do you think need to advocate for a change within a company for the company to make that change?
1%.
1%.
15.
15.
With how much shares they hold.
Depends on how much shares they hold.
51%?
51%. It depends on the scale of the change, the amount of shares hold. There's a lot of politics, obviously, to it. The number is actually 5 to 10%. 5 to 10% of shareholders have to advocate for change, on average, for a company to consider that change. Now, when you think about it, let's say you're a business owner. You own a corner deli. 5 to 10% of your customers come in and say, we want paper bags. Are you going to wait for it to be 51%? Are you going to wait for it to even be 20 or 30%? No, you're going to get paper bags. Obviously, that conversation gets a bit more complicated when there's another 5 to 10% which are saying paper bags are death. If you get those, I'm never coming in the store again. Increasingly, though, what we're seeing is that large-scale institutional investors, as well as retail investors, are getting involved in advocating for change in this space. Recently, a group of 70 global investors, institutional investors, got together and wrote a letter to the 45 largest fossil fuel and utility companies. These investors controlled $3 trillion worth of investments. Very large scale. What they said was, we're worried about the sustainability of your business plan as a fossil fuel company, as a utility company. They weren't just saying we're worried about the environmental sustainability though. They were saying, we're worried that because you're relying on this antiquated system of energy, how are you going to deliver returns to us moving forward? We need to see your business plan for adapting to how you're going to deliver returns in the future. I think a really exciting conversation taking place there. Finally, impact investing. Impact investing is the one that gets me the most excited. It's investments made that generate measurable social and environmental impact alongside a financial return. So let's say George says, I'm not doing the egg store anymore. I'm not doing this. I'm going out, I'm finding a farmer. I'm going to buy my eggs directly from the farmer, and that farmer says, great. For every dozen eggs you buy, I'm going to give you a little measurable letter that says you saved 1 chicken. So the measurable social environmental impact. Really fascinating example of this that happened in New York. In New York in 2012, there was an effort announced that was going to dedicate $10 million to reducing recidivism amongst youth on Rikers Island. For those of you, recidivism means when somebody leaves jail, how likely are they to return to jail? The thing about imprisoning people is that it's expensive. It costs a lot of money to keep people in prison. So there is a savings to be had if you can reduce the number of people that are returning to prison. However, New York didn't have the $10 million to invest in this project up front to reduce recidivism. So what they had is that they had private investors come in and say, we're going to provide the $10 million to you. Then the agreement was, if recidivism was reduced by 10% in 4 years, those investors would get their principal back and 25%. If that goal wasn't reached, then they would write it off as a charitable deduction. I see a lot of potential for this space to deliver capital to issues that have a good return on investment and are environmentally and socially positive. We're not at the place where individual investors can get robustly involved right now. And increasingly, we're seeing options come out for investors to do this sort of investing on an individual scale. It's a really rapidly growing, really exciting space. Now, can anyone tell me what this is a picture of? Cauliflower. That is one answer. The other answer is, it is a picture that comes up when you search for George and eggs on the internet. I guess the painter was probably George, and there's the egg. This conversation has not been very Midwestern focused so far. It's been on a lot of large-scale issues. There are ways that you as an individual investor can start to get involved in this space. When it comes to divestment, there are a rapidly growing number of mutual funds, exchange-traded funds, that are divested from fossil fuels, that are looking at this conversation and making sure that their investors are allocating in a way not related to fossil fuels. When it comes to shareholder advocacy, we actually have a group in Missouri, the Midwest Coalition for Responsible Investment. It's a series of nuns. It's a group of nuns who control a lot of religious and institutional funding, and they have been successful in advocating for Ameren and Arch Coal to be more transparent about their water usage. So they have had some big successes. And they're Midwest Coalition for Responsible Investment. They're a really lovely group of women, too. In impact investment, there might not be that formal environmental or social return. However, if you're investing in solar companies, if you're investing in companies whose mission you really believe in, you can start to deduce, hey, I might be helping to reduce emissions by helping this solar company capitalize. I might be helping this company have a better social impact because I'm helping provide them the means to grow. It's a really exciting space. Now, performance. Well, Jake, that's all well and good. How does this perform? how does it perform? The biggest objection I've gotten out in the community, talking to individuals in different groups about this subject, has been, that's all well and good, and I don't want to sacrifice performance to do that. I understand that. With the clients I have right now, I take their goals very seriously, and I want to help them progress towards those goals. Whether it's retiring, sending kids to school, getting their second home, whatever they have in mind. I don't want to compromise that. My objection is that a lot of people think that incorporating environmental, social, and governance aspects into performance is immediately a way to lower performance. I've done a lot of research on this subject, and that is not a foregone conclusion. In fact, increasingly what we're seeing is that incorporating environmental, social, and governance factors into your investment decisions is a way to enhance performance. We're going to talk about that now. First off, environmental, social, and governance investing is used in 1 out of every $8 currently invested in the US. Much broad. I was surprised by that number. I think it's a lot higher than a lot of people would have guessed. I probably should have had you guess. Second off, in this section, a lot of times when people are asked, when I ask people about what do you consider environmentally responsible investing, it's similar to Dane's first answer of think about those companies that are the most green, that are delivering those results, those solar companies, those cutting edge clean tech companies, and that is an important part of the conversation. In this portion of the conversation, what we're going to be talking about though is more established companies, companies that you'd see on the S&P 500. These are companies, let's use the examples of Pepsi and Coke. I don't think anyone in this room is going to argue that Pepsi and Coke were created to deliver environmental and social returns. They were delivered to make Pepsi and Coke. However, when you compare two companies like that, you see differences in how they are performing in terms of their environmental and social practices. One might manage resources better, like water, energy, electricity. The other might treat its employees better. One might be better at engaging with its stakeholders, making sure that the broader community is involved in the decisions that they make about their plants and about their operations. The other might be better at creating a diverse board with women and other races so that there's a more robust conversation in the boardroom. Now, Harvard took this principle of applying established companies and looked at 180 companies over an 18-year time period from 1993 to 2010. Those companies were largely, they were matched up so that they were the same size, same market revenue, similar opportunities, so that you were comparing apples to apples. This is more your Coke versus Pepsi conversation versus your, instead of your solar startup versus ExxonMobil conversation. So they were matched up in terms of their opportunities, in terms of where they thought the companies would grow. And then they were differentiated based on their environmental, social, and governance characteristics. So the researchers came up with a whole laundry list of practices that could be related to environmental, social, and governance investing. They said, how do these companies manage water? How do they treat their employees? What sort of benefits do they have? How are they engaging their stakeholders? Whole list of 100+ criteria. Through that, they created 90 low sustainability companies, 90 high sustainability companies. They compared performance over that 18-year time period. The high sustainability companies outperformed by 40%. To put that number into context, if you had invested $100,000 in 1993 in a basket of the low sustainability companies, you would have had $1.54 million in 2010. If you had invested that same amount in the high sustainability companies in 1993, you would have had $2.26 million. Now, we're not all Harvard Business School professors with perfect hindsight. So, how do we do this? How do we implement these ideas in our own life? Well, What most of you might have if you're involved in a 401k or a IRA is you might use mutual funds. You might use exchange-traded funds. So this UN study was looking at how do mutual funds that have an investment manager who's asking what is the environmental, social, and governance practices of these companies compared to mutual funds that have investment managers who say, I just want to invest for return. I'm just going to invest in the traditional way. So the UN study found 20 different papers that were looking at that conversation, looked at them all. What it found is that three of the papers it found said that investment managers looking at ESG leads to underperformance. Those mutual funds don't perform as well as those that are just looking to invest for return. 7 of the studies found that investment managers incorporating environmental, social, and governance factors led to neutral performance. Same performance as those that were investing in a traditional way. Finally, 10 of the papers found that investment managers, including environmental, social, and governance factors, led to those funds outperforming compared to traditional means. I'm excited by that. Excited by a lot of stuff. There was a secondary UN study that looked at transit-oriented development and how it affected how communities. No, I'm just kidding. This is something that comes up when you search for very fast cars. If you notice too, it's going to the pleasure beach, which I particularly like. Now let's bring George up to the mid-'80s. George is in the mid-'80s. He's driving an old American car. It's the middle of the gas crisis. And it's burning a hole in his pocket. He's spending a lot of money on gas. He's considering getting a Japanese car. He's heard they have better mileage, better fuel efficiency. He's also heard some horror stories, though, about their performance. They break down, that they're not reliable. Now, George finally makes the decision. He says, I'm going to invest. I'm going to do it. I'm going to get a Japanese car. What he finds is that he enjoys it. He likes the performance. He enjoys the car. He likes that he's spending less money at the fuel pump, and he likes that he's helping the environment by burning less gas. The point of telling that story is that, especially when we're talking about these established companies, environmental, social, and governance investing is not some new weird car. It's not a motorcycle. It's a car with different features. The features are that those investment managers say, I think that environmental, social, and governance practices in companies are important. I think they're important in a way that is not always captured by just looking at the financials of those companies. In the Harvard study, what they concluded caused the outperformance is that those companies managed their resources more effectively, were better at investing in and retaining talent, and were better at creating a diverse board and engaging their stakeholders. They found that doing those things led to being better companies. Who knew? Now, potential. I'm going to take another poll right now here. How many of you think that the issues of sustainability when it comes to resource management and energy efficiency will become less important for companies over the next 10 years? How many of you believe it will become more important? Surprisingly, I also find myself in the latter camp. People look at me when I'm stupid when I ask that question, and rightfully so. It's a stupid question. The point, though, is that if you believe that change is going to happen, and you start to look at the implications of that change, it has huge impact on our economy. Even in the next 10 years, I think there are huge impacts to the economy, to how our investment world works. Now, let's bring George up to present day. George is now driving a Chevy Volt, buying his eggs from Tower Grove Farmers Market. He's a pretty happy guy. But he's thinking, I think I'm going to put solar on my house. I think I'm going to decide, and I'm going to do that. Well, as many of you in the crowd might be aware of, if he had waited until today, he would have been hurt. He would have missed out on a robust Missouri subsidy for solar because of an unexpected interpretation of the regulation that created that subsidy. It's a really interesting story. I won't get into it now. The point being that I want to make sure to say that there is risk involved in the clean energy space. People talk a lot about regulations and subsidies and everything like that. And I'm going to talk in this next section about the clean energy space, and I want to be clear that there is risk involved. However, on the flip side of the coin, I think there's risk involved in the traditional fossil fuel energy space too. Now, if I start to talk about a carbon tax or a carbon regulation, if I were in your seat, I might start to have my eyes glaze over. I'd be internally thinking, yeah, and look at DC. Look at the sort of dysfunction and partisanship we have in place. How are we going to pass any sort of robust regulation or carbon tax in this environment? It's disheartening. When you start to look at how companies are looking at this conversation, though, you see some surprising things. A recent study looked at 29 of the largest companies in the world. Not allowed to say names because of compliance. One of them rhymes with Snapple. The other one rhymes with Mexon Tobel. What it found is that those companies were using an internal carbon price. Each one of them. Their executives had sat down and they decided, we think that carbon is going to become more expensive moving forward. We don't quite know how. And we need to start preparing for it, though. It's an important conversation for us to be involved in. A quote from the author of that study said, "It's climate change as a line edit. They're looking at it from a rational perspective, making a profit. It drives internal decision making." Now, when you look at the scale of the conversation around regulation and carbon, it becomes pretty clear why you want to be thinking ahead on this conversation. A group of Oxford scientists got together, Oxford researchers got together and said, so if there is ever regulation to keep us in that 2 Celsius degree limit of warming that's been set by the Intergovernmental Panel on Climate Change as safe, how are the traditional fossil fuel companies going to be affected? How are their business models going to be affected? What they found was an interesting thing. If we expect to stay within that 2 Celsius limit of warming, then 60 to 80% of the current oil, coal, and gas reserves would need to be unburnable. Those reserves are already priced into those companies' bottom line. What that means is that if those reserves become unburnable for any reason, there was a study from HSBC, a global bank, which said that that would lead to a 40 to 60% drop of valuation in those companies. For those of you that follow the stock market, the S&P closed at 1870 today. That would be the equivalent of it falling to 1,000, 900, 800, a dramatic fall. Now, this conversation is not just being had by radicals at Oxford. ExxonMobil recently came out with a report that said stranded assets are a real conversation that we're having internally. They recognized it publicly. Now, there was some pressure from a sustainability-minded institutional investor, but they did end up saying it. Finally, the last point here, 30% chance of carbon tax by 2016. That number comes out of a recent interview I read with David Bailey and David Bookbinder, 2 of the founders of a group called Element 6, which is a group, a consulting group based in Washington, D.C., which looks solely at carbon tax and that conversation. The interesting thing about these 2 men is that David Bailey is the former climate policy manager for ExxonMobil. David Bookbinder is the former chief climate counsel for the Sierra Club. They found that when they were talking from these 2 very different perspectives around carbon, they had more common ground than they thought. These 2 experts on the conversation found that they had enough agreement to start a company together and to come to this number. Now, I'm not saying that you should hang your hat on this 30% chance number. What that is there to stimulate is that these two very smart, very knowledgeable men think this is happening much sooner than the common consensus would be. Oh, don't know how that happened. This is a graph from the U.S. Department of Energy. It shows the projected growth of renewable energy generation in the U.S. over the next 20 years. Now, Bloomberg New Energy Finance has estimated that clean energy investment on a global scale could triple by 2030. That's a huge number. And I don't think, yeah?
Can you go back to that slide?
Sure. We can sit on this one, it's a lot more engaging. Now that tripling is a huge number, and personally I think it's low. You start to think about the potential urgency of the conversation around sustainability, around the need for renewable energy. And I don't think oftentimes it's incorporated into this conversation. Yeah?
Can you explain that biomass, please?
No, I can't. Yeah, I'm not sure.
Is that burning?
Oh yeah, well biomass is,
Landfills?
it could be landfills, I mean, it could be
Biofuels.
biofuels for the large part.
Grasses, corn.
Yeah, I don't know what the growth is being projected from. I
Yes.
know there's a lot of different reasons why it could be happening.
But the California Highway Patrol has something to do with it. Industrial California Highway.
What is a CHP?
CHP. I probably should have taken a closer look at this graph before. I can't say I'm an expert on this one.
It's combined heat and power.
There you go. Well, luckily we have some experts in the crowd though, so getting my back.
Okay, go ahead.
Okay, I'm gonna go on to the next slide. That one was causing The point of this, though, is to say that if you believe that this change around sustainability is going to become more urgent at some point, if you believe it's going to get quicker, then there's a lot of different industries you can look at and start to say, man, that could be a growth industry. Hybrids and electric vehicles, we're already seeing that start to take place. Smart grid technology, energy efficiency, all of these different areas that have the potential to be an incredible part of our economy moving forward. Now, the interesting thing about changes like this is that people expect the status quo to continue and then to know when some sort of change is going to happen. It's kind of a human characteristic that we expect to say, oh, I'm going to know when X is going to happen. I'm going to know when the stock market goes down is an unfortunately common idea among many financial advisors. Oh, I'll just wait until I know it's going to go down and then I'll get out. Oh. What we found, though, is that humans are very bad at that. Now, you've probably caught on that these are random pictures, so I'll just tell you what the caption for this one is. For some reason, this picture comes up when you search for solar car eggs on Wikipedia. I have no explanation for it. Solar car eggs. So this is kind of our au revoir to George. I was having a conversation with a portfolio manager recently that I work with, and he was telling me about a discussion he had with a prominent Greek politician. What that politician was telling him is that many of the leaders in Greece in the run-up to the financial crisis could see the writing on the wall. They could see that there was this crisis building. But they dealt with other things, they shuffled papers, they maybe nibbled at the corners until it was too late. I think in the investment world, the same thing is happening around sustainability, around environmentally responsible investing. People are nibbling at the corners, they're not really getting involved in the conversation at both the large and the small scale. Now, the thing about that is that things are the same until they're not. And so, they're the same until they're not. I know it sounds simple, and I think it's an important point to note right here. So, how do you prepare for this, though? How do you think about this proactively? These are huge conversations. How do you start to get involved in those conversations? Now, before we dive into this, I'm going to list the 3 reasons I think it's important to start having this conversation now. The first reason is because you want to pass your own personal wake-up test. If you're invested in a way where you don't reflect your values, I think there are smart ways to do that. I think it's time to start exploring that conversation. That's a personal value of mine. That's something that I espouse to people. Second off, there is real risk in business as usual. As you can tell from the conversation around carbon regulation, around the shifts that could happen in our economy, there's real risk to not thinking through what those changes could be if you believe that they're coming. Secondly, there is real opportunity as well. There's the chance to get on the ground floor of really exciting, really groundbreaking technologies, industries, in a strategic and intelligent way. By doing that, you're going to take part in some potentially dramatic upside. So how do you do that? Jake, how do you do this? There's a theory in finance that every investor has 3 buckets of money. You have your safety bucket, goal of which is to grow by inflation. It's your sleep well at night money. You have your core bucket, the goal of which is to grow by inflation plus 4 to 5%. That acts like your personal endowment. And then you have your tactical bucket. That's where you take more risk for more reward. It's where you kind of try and swing the bat, I'm not good at sports analogies. Hit it out of the park. Within each of these buckets, there is a way to start to think about environmental, social, and governance investing. In the safety bucket, that's typically more boring things like US Treasuries, global Treasuries, TIPS, things like that. A really interesting example I saw there recently, though, is that there was a fund that focused on community revitalization efforts in low to moderate income communities. Now, this fund was very conservative. It was insured by the US government, it did not pay a high return, it was not a sexy investment, and you were still helping to capitalize those projects in communities that needed them. In the core bucket, that's where we start to talk about the mutual funds that investment managers are creating, or the exchange-traded funds that investment managers are creating that we covered in the performance section, in section 2. Finally, in the tactical funds, that's where you start to target clean energy. That's where you start to think about, where do I think the conversation is going? You kind of step out on a limb and try to get involved in industries that you're really excited about, that you're really wanting to help support and participate in. Now, you can have your entire portfolio in ESG. You can do, I just want to do tactical, or I just want to do core. You can incorporate it in a way that's suited for you. What I hope, though, is that you walk away from this presentation tonight feeling like you can get started in that conversation, feeling like you have some tools to do that. I've talked to many people who have come up to me in the community and said, I went and I approached my financial advisor about environmental, social, and governance investing. And he told me that I couldn't really do it. It can't be done. I have another advisor from my office, Todd, here tonight, and he's one of the few that I've heard that actually did say, yes, we can do that for our portfolio. But a lot of advisors who are there say, we can't do it. You're going to sacrifice performance. Here's one crappy mutual fund that I'll put you in. I don't think that that is the case. I obviously think that there are more options to you, and there are reasons that you should be thinking about this, not just for your values, also for your performance. Now, last section, have a plan. When you look at the world we're living in right now, it's a very uncertain world. And when you start to just look at the investment world in the US, you see that over the last 30 years, inflation rates have gone from high to low. Interest rates have gone from high to low. And government debt has gone from low to high. In addition to that, we've seen experimental monetary policy, we've seen a change in the workforce, we've seen changing global economic demographics. There's been a lot of change over the last 30 years. Now, the important thing for you to do whether it's talking to your advisor, whether it's talking, if you manage your own investments, talking to yourself, it's important to ask yourself, or your advisor, tough questions. Ask, how am I prepared for these different circumstances? How am I prepared for a potential rising interest rate environment? How am I prepared for carbon to become more expensive? Ask tough questions and expect good answers. Oh, messed that up. Sorry, just 1 second. All right, I'm gonna end on a story. Now this is a true story that I made up. Captain George Williams is on the helm of the USS Abraham Lincoln. He's in the South China Sea. He has his first mate run up to him and says, "Captain Williams, we're on a collision course with another radio signal. What would you like us to do?" Captain Williams says, "Hand me the radio." So he gets the radio and he stands up there and he says, "Hi, this is Captain Williams on the USS Abraham Lincoln. We are currently on a collision course. Please divert your course 15 degrees to the south." Here's promptly in response, "No can do. Please divert your course 15 degrees to the north, Captain Williams." So somewhat taken aback, gets on the radio and says, "I don't think you quite understood. This is Captain Williams of the USS Abraham Lincoln. USS Abraham Lincoln. We're an aircraft carrier. Please divert your course 15 degrees to the south." To which the other guy says, "No, I understood there, Captain Williams, but no can do. Please divert your course 15 degrees to the north." So, infuriated at this point at the hubris of this other person that would dare defy him, Captain Williams gets on the radio again and he says, "I don't think you did understand. This is Captain Williams at the head of the USS Abraham Lincoln, the most advanced, most weaponized aircraft carrier in the entire world. If you do not divert your course 15 degrees to the south, immediately I will be forced to take counteractive measures." Other guy gets on the radio and says, "That's all well and good, Captain Williams, but we're a lighthouse. Your call." If we return back to the questions I asked you at the beginning of the presentation, I hope you have a better understanding of what environmental responsible investing is for you. I hope that you have a more robust conversation in terms of the role that environmental, social, and governance investing can play when you look at performance of investments. Finally, when you look at how environmental, social, and governance investing will be used in your own personal portfolio over the next 10, 20, 30 years, I want to stress that I don't know what's going to happen. Anyone that tells you what's going to happen is likely lying to you or lying to themselves. What I've been trying to share with you today is a lighthouse. Now, the head of climate science, James Hansen, once said that the odds of climate change not being real and not being serious are similar to the odds of one being able to quit their job and play the lottery every day to successfully replace your income. I don't like those odds. So today, I hope I have helped you divert your course 15 degrees to the north. Thank you very much. Thank you all so much for coming. Before we dive into questions, I just have a couple of quick housekeeping things. First off, I'm going to send some feedback cards passing around. The purpose of these is that I'm trying to get out to as many groups as possible to give this presentation and always trying to improve it. So if you have some piece of feedback, something you liked, something you'd like to see more of, something you didn't like, please let me know. Another couple of details on that. If you put your name or if you put your email down, then I'll sign you up for our monthly sustainable investing newsletter. What that basically is it's a newsletter that my partner and I send out that just covers interesting articles we've seen in this space over the last month. So just a few links and a brief description from us. Finally, If you were curious about how this might relate to your own investments, if you did want to talk to me, I would be happy to do so. Please just put yes on that, would you like to meet and talk about this? Whether it's for your own personal investments, whether it's just you're curious about something, I promise I don't become a used car salesman suddenly when you sit down for coffee. I love this topic, I love to talk to people about it, and so I'm always enthusiastic when people are interested. Last note, if you do know of another group in town that might be interested in this topic, I would love to hear about where they are or who they are. Be put in contact with them. I'm always looking for different groups to reach out to. So, with all of that said, what questions do you have? Yes?
Speak to like church groups and that, or?
Yeah, I've actually, I have a couple of talks in August at the Ethical Society. Yes?
What will be the likely impact? Talk about Stanford divesting from fossil fuels.
Yes.
What will be the likely impact of stock prices on fossil fuel companies if that continues?
For just Stanford or for if it kind of domino effects?
Yes.
So with the Stanford decision, one of the things that they were very much open about was that this was symbolic, that there was no real effect on the stock price of that company. What will become really interesting is that if that symbolism continues, I mean, there's $400 billion invested with college endowments. Now that's a lot of money, and it's also not as big as when you start to look at institutional investors in California and New York, in places like that. So I think it could have an effect, and it'll likely be one more of kind of symbolism and of this growing cultural movement, rather than as much of a direct economic effect. One interesting point on that is that I read a study about apartheid and the successful divestment movement there. And one of the studies I read concluded that the apartheid divestment movement didn't have any effect on the stocks of those companies that were being divested from. The reason it was so successful was because of its cultural significance. Yes?
Mind if I have a question and a quick comment?
No, please, feel free.
First, a question. How much of the assets that you're managing along this line are active versus passive?
Yeah, I would have expected you
Explain
to
the
answer.
active and passive.
Yeah, so
what you've said.
active investments are when you have a mutual fund manager, when you have someone picking a smaller bundle of funds and kind of being more active about trading those and being more active about making sure that they're fitting his schematics, her schematics. Passive is more of an exchange-traded fund where it's like an index and it's just capturing kind of a snapshot of a market. My partner and I bias towards passive management. What we've found is that when you're trying to diversify in this space and looking for environmental, social, and governance options, your options are sometimes limited because there aren't as many ETFs, passive options, that have investment managers who are looking at environmental, social, and governance conversations. That's in the core bucket. However, when you start to get to the tactical bucket, we're invested in water, we're invested in solar, there's a lot of options, more and more ETFs actually that are sector specific in that area. Yeah.
One quick comment.
Yeah.
What Jake had mentioned about having a plan, I'm just going to elaborate just a little bit, and I suspect that you'll agree with me on this. No matter what direction you go, if you do go towards the environmental, great, but I will see the future a little bit in this way. There are going to be times that the environmental portfolio is going to look like it's doing tremendously better, and you're going to be happy. And there are going to be times it does tremendously worse, and you're not going to be happy. Do not decide to, oh, it's doing badly, I've got to get out, because it's just going to be in the rearview mirror. The one guarantee that you do have is if you react to it, you are going to end up losing money. So just go at it, get a number that you're comfortable with, and stay with it, because over the long run, I suspect as Jake does, it's probably going to be about the same return, maybe a little bit better, But it is going to have times that it's going to outperform, and there are going to be times that it underperforms. Don't shoot yourself in the foot. There have been many, many studies showing that investors that react out of fear and greed, those are the ones that get, well, the shaft, time and time again.
Yeah, that's a great point, and just to kind of elaborate on it, oftentimes when the most successful financial plans are when you feel comfortable with it and when you are ready to sit through those hard times and still have faith that you're working towards your goals. That's a great point. Thank you, Susan.
I have a follow-up, or just an additional question. On 3, you talked about potential,
Yeah.
and you had internal carbon pricing being used by a couple of different companies.
Right.
What did it mean 60 to 80% of current coal oil reserves could be unburnable?
So
can you explain that?
Yeah, so to elaborate on that point a little bit more,
Yeah.
the term that those Oxford researchers are using is called stranded assets. And what that posit basically is that if any sort of regulation comes into play to limit fossil fuel, to limit the emissions level, then those would become stranded assets. They would be assets that a company held and was no longer able to use. So unburnable, it would be due to the regulation to keep warming within a safe level. That's what would make it unburnable.
So they can't use them in production, or?
They can't burn them unless, they can't use them, period, unless there's some sort of carbon capture and storage technology.
Okay.
Yes?
Do you have any knowledge of, with this big political battle with the Keystone Pipeline, the efficiency of using tar sand, oil, whatever they call it, versus the normal type of oil that you get out of wells around the globe?
I'm not, I read this report a while ago, so don't quote me on this. I think it was saying that because the tar sands oil is more emissions heavy because it takes so much energy to extract and process it. And I think it was saying something along the lines of 20 to 30% more energy intensive, more emissions heavy to process that. I'm not completely sure about that. I think it was around that range though.
That kind of sounds what I've heard, but there's also a lot of waste products.
A lot of what, sorry?
Waste products that we're not allowed to burn because the
Yeah.
emissions are so high in this country.
Yeah.
And I understand we're shipping it to China and places.
Yeah, that's the complex part about one of the things that they've talked about is, if the tar sands, if the Keystone Pipeline isn't built, then maybe they'll just build a more expensive railroad to ship it to the West Coast and then send it off to China because their energy demand is incredibly high. They're also the highest producer of solar in the world now, so kind of dual worlds of China.
Yeah.
Could you explain carbon capture?
Yeah, so carbon capture and storage is basically there's technology that's being researched where if you are a coal plant, the emissions that come out are captured and then stored underground. The technology to do this is there. The problem is that it's prohibitively expensive as it currently exists. So there's no real political will to put it in place. However, I was reading an article that was talking about how coal is likely to be part of our energy generation moving forward. I mean, you look at the growth in China, you look at the growth in India, it's hard to see coal not playing a role.
There's a lot of coal resources.
There's a lot of coal resources. So some people say carbon capture and storage is going to have to become part of the conversation. Sorry, did I not answer that? Okay.
This may apply more to the tactical pot than the cork pot.
Right.
It's my imagination that there are a fair number of companies out there, some of them more new and innovative and risky.
Yeah.
What kind of strategy do you use to try to kind of create a balanced portfolio that
Yeah.
it allows for income but also limits risk some?
So that's part of the reason we use passive investing in that space. So there are solar exchange traded funds. So they're passively invested, there's low fees, they're invested in a lot of things, and it's still taking part in that solar space without being those individual companies that would have a lot of risk involved in them.
Okay. And so in the other aspects as well as the solar.
Yes, yes, yeah. We have a couple solar and tactical. We're also doing some things in water and exploring some other avenues right now.
Could you talk about how you choose among those, or balance between sectors or stuff like that?
In the tactical space, it's really just kind of, I wish my partner was here, he's much better at talking about these things. No, in the tactical space, we had a conversation, we basically looked at, a lot of different factors. How is it priced right now? What do we see the opportunity? It's an ongoing conversation always. So I'm sorry I don't have a more distinct answer. That's how we discuss it and kind of move it. Yes.
You mentioned the electrical grid. How does that play into this?
Electrical grid.
That was up on
The smart grid technology.
Yeah, smart grid.
Yeah. I think the electrical grid is going to be a really interesting conversation moving forward. Part of the reason for that is that it's oftentimes public works, public infrastructure, so it's not as much the private companies that seem to be doing that. When I was saying smart grid technology, I think there's going to be increasingly options that are focusing on how do we make the grid more intelligent. A really interesting example of that is I was talking to an architect recently who was telling me that off-grid became immensely more popular after Hurricane Sandy, because people had seen that with the grid as it is currently operated, if you have solar on your house, but the main generation system goes down, your solar doesn't work. So all these people in Hurricane Sandy, all these people in New Jersey and New York who thought they would have power, suddenly when the main generation goes out, they don't have power. So I think increasingly there's going to be people looking at how do we kind of solve this conversation on a smaller scale? How do we get technology that can work on that level?
By the way, just to elongate that answer, one of the newest things that have been out, and this goes to an article that was just out a few months ago at most. I think it was Honda developed a car that you could incorporate into your home's electrical system.
Yeah.
So that it could be independent of the power grid, so that basically when your car's in the garage and you've got the solar on your roof, you're charging up your battery so that when you need the power later on, you've got it for your home at that point.
Would it be nice if the power went out, you could turn your car on to...
Actually, basically, that's what it sort of is.
There's literature that refers to that as mobile storage.
Yeah. Yeah.
The other thing on that line is to make renewable energy work, there's solar energy in Southwest,
Yeah.
and there's wind in the center.
Yeah.
But if it's rainy in the East Coast,
Yeah.
how do you power the East Coast?
Yeah,
Right, so you have to
exactly.
make power from the Southwest and
Yeah.
the Central
Yeah.
around the world, around the country. And that grid, well,
Yeah.
right now we don't have it, can't move electricity.
Yeah, well, I think we were both at the sustainability conference
Yeah.
at Webster. It's really interesting what some of the people in
Yeah.
wind and specifically the woman in wind, what she
Yes.
was talking about is actually private companies starting to, work on building those transmission lines with public support. So there are some innovative financing options that are coming out in that space. Yes.
I'm a little concerned with this term, ESG, needs sort of to be nailed down. In other words, it's going to mean different things to different people. Is there
Yeah.
any concern about there being sort of like a standard for this standard? This is what this means.
Yeah. So what you're seeing right now in this space is that there are different groups jockeying to be that kind of gold standard, as we are the ones who measure how environmental, social, and governance friendly you are. For those of you familiar with the LEED system for building, in the building world, LEED is kind of not seen as the perfect solution. It's seen as the solution that, that came to fruition and that gained a lot of momentum. And I think you're going to see the same thing start to happen in the investment world as time goes forward. There's going to be this gold standard that through whatever means starts to become the kind of the comparison block.
Am I remembering this correctly? I think I read something about the New York Stock Exchange and maybe other exchanges also putting pressure on their members to be more transparent,
Yeah.
to incorporate into their reporting, integrated reporting, more information about their resource utilization
Yeah.
and how vulnerable they are.
Yeah. A lot of, there's the Dow Jones Sustainability Index, which is very competitive to get on right now, and that's one thing that people look at. There is pressure from groups to be more transparent around this conversation. Europe actually just recently mandated reporting on environmental and social, certain environmental and social practices of companies. They said, if you're an X size company, you have to report on these factors. There's no question. Finally, for those of you familiar with Bloomberg, Bloomberg Terminal is something that's used by many traders to look up financial data on different companies, and they've recently just released a carbon valuation tool. So what that is that they're increasingly creating this metric by which you can go into a Bloomberg terminal and say, what is the valuation of this company when it comes to carbon? What is their exposure to the carbon conversation? So we are starting to see these metrics come into place.
The other group that you and I were talking about previously, CanV, or was it that actually did the social
Ceres?
response? Yes.
Yeah, series.
That actually has been doing those sort of evaluations for many, many years.
Yeah.
So it's not as new as it actually sounds.
I think many of us are probably locked into 401ks that
Yeah.
the company has to offer.
Yeah.
Are there ways to encourage or get sustainable investment through 401ks with limit options?
Talk to your 401k manager, and if you have a broader group of people, bring them to talk to the 401k manager. You know, oftentimes there is an environmental, social, and governance factor that can be incorporated as a fund or as a fund of funds. What you do is you push for that, and you push with the if you can start to build a broad enough coalition, then your employer can obviously switch to a different provider for a 401k to on the guise of we want better environmentally and socially responsible options.
I missed a number. You had said something about $1 trillion worth of damage on the coasts from global warming. Do you remember that number?
35.
35 trillion?
Yeah.
I have to bring home numbers. Real numbers.
Was that before or after the West Antarctica ice sheet collapse?
I don't know.
I think that's twice as much as our government now owes debt-wise. So no ticket number.
Is this for to Jake?
No, but if you put your contact information, or I can give you my contact information afterwards. I am stupid about not bringing business cards to places.
A number of years ago, there were some regional carbon exchanges set up. The one that got the most press was one in New England.
Okay.
I don't know what's happened with those, and I don't know whether that's any sort of an indicator of what might happen on a federal level.
Yeah.
Do you remember anything? You might be too young. Do you remember anything about
I'm
that?
sorry, I haven't heard anything about that, so I'm not
It's
sure.
a number of years ago.
Yeah.
Well, I'm sure Jake would be happy to stick around if you have any more questions. Please take a reusable grocery bag or 10 on your way out. And I hope to see you again in 2 weeks. Thank you all for coming.
Thank you.